So let me skip through the disclaimer. You can read that one later, and let me give you a quick introduction to Orcadian Energy. We're very newly listed in the AIM market. We were listed on July the 17th, but actually we've been around a while. We set the company up actually about 7 years ago. We were founded in 2014 to apply for the pilot license, which is our core license. In the time we've been a business, we've actually built an astonishingly large portfolio of reserves and resources and exploration possibilities. So let me tell you a little bit about the team. We have a great chairman. Joe Darby is our non-executive chairman. He used to be CEO of Lasmo. You might well know him from that. He was also chairman of Faro when they listed. You probably don't know Christian Wilms. He's our one of our non-execs. He's senior vice president of reservoir and subsurface at MOL, the Hungarian company. And between us as a whole team, I won't go through everyone on the team, we have a lot of experience of UKCS, oil and gas developments, and viscous oil in particular. So we listed a name in July. We came to market with 79 million barrels of 2P reserves, proven plus probable reserves. That's actually, astonishingly, the largest volume of any UK-focused oil and gas company that has ever come on the AIM market in terms of 2P reserves. Lots of other companies that come with contingent resources and prospective resources, but reserves don't have any of that exploration risk or appraisal risk. These are assets where the development plan is profitable, and our reserve auditor thinks we have a high chance of finding the capital to move those projects forward. So we're also committed to operating at the highest ESG standards, and we've just submitted to the Oil and Gas Authority an amendment to our concept select report for the pilot fields, which was focused on minimizing emissions, and we're hopeful of getting a feedback from the Oil and Gas Authority pretty soon on that. So let me just run through a table of the various assets we have and the reserves and resources associated with them, and then I'll show you where they sit on the map. So Pilot is the core asset. It's got 58 million barrels of proven reserves. Proven plus probable is 79. There's a possible upside as well. Elky, Narwhal, and Blakeney add up to 78 million of 2C contingent resources. So that's discovered and producible barrels of 157 million barrels. And we have some fantastic exploration opportunities. The Bowhead prospect is our favorite prospect. We're working very hard on that now, and we'll show you something more on that in a little while. That's a 43 million barrel prospect, 50-50 chance or thereabouts. And then we've got a series of appraisal opportunities and exploration opportunities around the Elky fields, which when you add all these things up, the risk total is 92 million barrels. You know, we're knocking on the door of having 250 million barrels to produce from these 8 licenses. So this is where we sit. We're in the central North Sea, 150 kilometers due east of Aberdeen. This small license in the middle is our core asset, and right in the middle of that sits the pilot fields. Our reserve auditors, Sproul, who are a Canadian-based reserve auditor, they're very experienced in viscous oils. They gave us a 2P reserve of 79 million, as I've said. That has a net present value of $640 million. That's a huge number. And that's based on us implementing a low salinity polymer flood using an FPSO, 2 wellhead platforms, and a floating wind turbine. So that this will actually be one of the first developments on the UK sector of the North Sea that will be powered by renewable energy. Sitting around that, we've got Elky, Narwhal, and Blakeney. Talked about them earlier. The NPV of those assets adds up to 458 million. So we're well over $1 billion of value at $60 a barrel and approaching $1.5 billion at $70 a barrel. There's low risk exploration opportunities around Pilot. Bowhead sits just to the north of Pilot. It's a pilot lookalike, very good chance of success, and a cluster of opportunities around Elkey. But I mentioned before that low emissions are really important. The Oil and Gas Authority have actually turned to all the operators and said, you've got to do better in emissions. You've got to do better in emissions. And they threw down a challenge to us, and we've worked really hard to get the emissions from our development right down. And we've ended up with a project that is in the low, it's at the low end of the lowest 5% of global oil projects. And a lot of people think heavy oil is much more difficult to produce, and therefore the energy consumption is higher, and so on and so forth. And that can be the case. I mean, this chart here, which is actually from a Stanford University data set, it was published in a paper by Masnadi and al. In 2018. This shows the emissions intensity of the production process of a big chunk of the world's oil production. So 80 million barrels out of the 100 million barrels a day that the world produces. And these red and orange bars are heavy viscous oils. But our scheme is right at the low end. It's 1.4 grams of CO2 equivalent per megajoule. And the way we've achieved that has been by essentially applying engineering innovation to the project. So if we decided to develop the pilot oil field just as a water flood, that would have had an emissions profile of around about 25 kilograms of CO2 per barrel. I apologize for changing units. I have one slide in one unit, one slide in another unit. They're different units. So a water flood would be 25 kilograms of CO2 per barrel. Typical viscous oils are 30. Actually, the North Sea average is 21. This is in 2018. Because we've gone for a polymer flood, and I'll show this in a moment, what a polymer flood does is it shortens the field life and it reduces the fluid handling requirements, and that reduces the energy consumption. And by reducing the energy consumption, you reduce your emissions. We're down at 14 kilograms of CO2 per barrel. We've worked really hard with our engineers to see how we can improve both the efficiency of our power generation systems and the process heat requirements. We've put some proper heat pumps into our process. I know there's a lot of talk of heat pumps in the press. These are big heat pumps. These are $5 million heat pumps. You add that into the process. We've been able to minimize our emissions substantially. We're down at just under 6 kilograms of CO2 per barrel. And then by adding this wind turbine, we've halved emissions yet again. We're down at 2.6 kilograms of CO2 per barrel. And you'll be hard pressed to find an oil project that has lower emissions than this one. So that's quite a bit of an intro on the emissions. This is a project that's delivering the Oil and Gas Authority's net zero agenda, and it's powered by renewable energy. Let's get into the nitty-gritty of the pilot oil field. So I've got a bit of seismic, I've got a log, I've got a hydrocarbon pore volume map. Let me just talk a bit about the field itself. It's really well appraised. There's 7 reservoir penetrations. So there's 5 wells and a couple of sidetracks. 2 of those wells were tested, and there's a couple of really high quality 3D seismic surveys. This is actually, for the technically minded among you, this is a colored inversion display. But you know, I'm an engineer and I'm not a geophysicist, but I can pick top sand here. I can pick base sand. I can see it pinching out as you go to the west. And you can see the change in the color of the reservoir going from blue to gray as you go from oil into water. And then as you come back in again and see a little gas cap that lights up really brightly, and then down to water, and then another gas cap. It's really relatively easy to define where the reservoir is with the seismic we've got. It's really good quality seismic, and it's a really good quality reservoir. It's very high quality sandstone. It's a turbidite reservoir, deep marine turbidite, 34% porosity, 2 to 10 Darcy's of permeability, 95% net to gross. Fantastic rock. You couldn't beat beat these rocks. The only issue that this pilot field has ever had is that the oil is somewhat more viscous than a typical light oil. And what that means, what we've seen is that in the south of the field, down about here, we've seen 160 centipoise oil. That's just like olive oil. In the north, this is 1200 centipoise, roughly like engine oil. So we know we get good flow from here. We actually have a 600-meter horizontal well here that tested at 1800 barrels a day. We've got lots and lots of data on this reservoir. We know we've got a fantastic volume of oil in place, 263 million barrels, and we expect to get 79 million barrels out using a polymer flood. So let me show you a little bit more about the polymer flooding process. It's just a slight variation on a water flood, and what you're doing in the polymer flood process is you're adding a little bit of polymer to the water, about 0.25% of polymer to the water, and that viscosifies the water, and that sweeps the oil out in a much better and more efficient way. So these two pictures here on the top right, they illustrate that. So they're pictures of a slab of core filled with 2000 centipoise oil, through which 2.7 pore volumes of water have been pumped in the top slab, and the red is oil, the blue is water, and what you see is the water's fingering through the oil and leaving most of it behind. The moment you put some viscosified water in, what happens is that flood front stabilizes and you get more like a piston-like displacement of the oil out of the reservoir. So it's a very simple process. It's a well-proven process. It's also been proven in the offshore setting. So Chevron implemented a first phase of a polymer flood on the Captain field, which sits in the central North Sea. That's gone so well that the new operator of Captain, Ithaca, has recently approved a £400 million investment in stage 2 of the project. And we're going to copy a lot of what has been done on the Captain project. We're going to learn from what Chevron have done. They have adopted an emulsion-based polymer for work offshore. That simplifies all the logistics and operations, but we won't do exactly the same as Chevron have done on Captain. They've done on the Captain field what's called a tertiary polymer flood. So they do a long water flood and then they do the polymer flood. CNRL, in projects they've worked on in Alberta and Pelican Lake, have seen a really substantial benefit by doing the polymer flood from the start. And we intend to do that as well. But let me show you a little bit more about what actually happened on a trial on the Captain field. So this here was completed in 2013. It's focused on a well pair in the southern upper Captain Sand. They're 125 meters apart. And in this chart, it looks very complicated. It's not as complicated as it looks. This is just time along here, and this is cumulative oil production. So first 18 months, they produced the oil under a water flood. Chevron then predicted this dotted line, how a water flood would evolve. But that's not what they did. They started to add the polymer. And what they found is that within a year, they produced that yellow slab of oil. They produced all the oil they expected to produce in the next 7 years. That's a dramatic acceleration of the water flood reserves. And then in the next 18 months, they added another 16% to the recovery factor. So polymer flood is a really good way of producing those slightly more viscous oils. And our development scheme here is illustrated in this cartoon. These are the wells. We'll start with one wellhead platform. We'll drill up these wells in the south of the fields. We'll have a jack up over that wellhead platform. We'll start with just 4 or 5 wells, and then we'll add to the wells as we're producing the field. We'll add a second wellhead platform, and we'll drill all the wells in the north. All the production will be handled on an FPSO, and we'll have this floating facility, floating wind turbine to provide energy to the scheme. So in terms of economics, I've already mentioned the economics, but this is actually a really robust project. At $50 a barrel, you're making great money. At $60 a barrel, you're making fantastic money. And at $70 a barrel, if you add Pilot and the Elky field, actually factored by the chance of development assigned by our reserve auditors, you're talking about $1.4 billion of value. And that equates to almost 16 pounds a share price. At $60 a barrel, it's 11 pounds a share price. Now, we wouldn't keep all of that net present value when we strike a deal with a partner to move the project forward, but we'd surely aim to keep as much of it as we could. And our next step is to actually secure some development partners to work with us, either an oil company or perhaps an alliance of contractors, so that we can deliver a fully financed field development plan. We have a farm out process underway. We're using some advisors to help us in that process. It'll take as long as it takes. I don't like to predict these processes. When people ask, I always say it's just as long as a piece of string. This is a big project, it's a complex project. It'll take some time to pull a deal together. But we're also going out to the FPSO market to see if we can get FPSO contractors to propose a vessel to be the core asset in developing the field. So the FPSO accounts for about 60% of the capital we need to find to get to first oil. And we'll look at all the options to get the capital, to get the project forward. And what we'll do is we'll choose the approach that maximizes value for shareholders. And why will we do that? Well, we're really big shareholders in this company. So our focus is delivering value for shareholders, and it always will be. So if Pilot comes in, as we expect, we'll be producing about 30,000 barrels a day. The Bowhead prospect comes in as we hope, that'll be maybe 50,000 barrels a day, and Elky, Narwhal and Blakeney can fill up capacity in the FPSO for a good long time. Let me show you a little bit about the Bowhead prospect. I won't dwell too long on this. It's a great prospect. We're actually in the middle of looking at a completely new seismic data set, and we will use that new data set to inform our decision on whether or not we want to drill this prospect. At the moment, on the data sets we've seen previously, it looks a dead ringer for Pilot. Outlined in orange here is the Pilot field. This is a little gas cap. You can see it quite brightly here. This discovery over here has a gas cap. That's why it's so bright. And the Bowhead field lights up just on these near stack amplitudes in exactly the same way as Pilot. You go over to the far stack amplitudes, which give you a bigger response when there's oil in the prospect. Pilot lights up very brightly, Bowhead lights up very brightly, and you see some conformance to structure here as well. These are all the clues we look at to decide, is this actually a prospect worth drilling? Look here, Blakeney, which is one of our other discoveries, lights up on the fars, didn't light up at all in the nears, but the fars tell you there's oil in it. So we're quite excited about this prospect, and we'll take that decision though only if it adds value for investors. So our objective is really simple. We want to add a lot of value for investors, and the way we see we'll do that is by fully financing the Polymer Flood project for Pilot. We've got our two approaches. We're looking for farm-in partners. We're looking to structure a contractor alliance. We're going to add to the Pilot project through some focused exploration and appraisal. We'll drill low-risk prospects close to our infrastructure that can really increase the project scale. And we'll also look at the resources we have, the contingent resources we have, put together good plans for those so that we can progress those into reserves as well. So in the end, why invest in Orcadian? The main reason is we have a really substantial, proven and probable reserve base, audited by a first-class auditor. Spruler, absolute first-class auditor. And it's surprising how many pre-development companies on AIM don't actually have up-to-date CPRs with first-class auditors. And very surprising how few of those pre-development companies have reserves under their belt. most of them have contingent resources and prospective resources, and they have great promises of how they'll turn them into reserves. We've already got the reserves. The project's really well advanced. It's wholly in line with the Oil and Gas Authority's net zero goals. And when you add up the net present value, you end up with share prices that are really very substantial. We see multiple paths forward to finance the project, but maybe the best reason to invest in Orcadian is that you're backing a management team that owns a very big stake in the company, and we're absolutely aligned with shareholders, and we're absolutely focused on maximizing shareholder returns.
You spoke about doing a great deal and an awful lot going on in the background. What's the Capex for the various projects, especially the polymer flooding on the Captain field?
Well, what I'll speak about is the Capex that's needed to get the pilot field into production. So it's roughly $1 billion to get to first oil. And the FPSO makes up about 600 million of that. So that's why the FPSO, and engaging with the FPSO contractors to find out, can we lease this FPSO rather than having to pay for it up front? That's such an important conversation for us to be having with the contractor community. There's 3 chunks of about 130 million each that make up the balance of the capital. One of those chunks is one of the wellhead platforms. That's roughly $100 million plus. One of the chunks is for the turret and the infield flow lines, and the other chunk is for the first 4 or 5 wells. And actually, the first 4 or 5 wells is where we see another opportunity for contractors to make a contribution to the capital in this project. We have in total here a 34-well drilling program. Nobody else in the North Sea has a 34-well drilling program. It's just nobody has a program like that. And the industry is going to be very interested in securing that program. And we'll approach drilling contractors and well service companies like Schlumberger, Halliburton, Baker Hughes, and look to them to say, look, help us finance these first 4 or 5 wells. We'll pay you back out of production after 12 months or so, and you'll be locked in for that 34-well program. So you can see a number of ways that we can shrink that amount of capital down. And the other thing to say about the capital is we have proven reserves. That means that we're able to go to reserve-based lender and actually secure some element of debt. Obviously, there'll be some equity to make the project work, and that's where the farm out to some other oil company, or possibly we could look to raise money in the market. Don't rule out any of the options, but what you can rely on is we'll pick the option that minimizes dilution in the project for shareholders.
Okay, so when you talk about partners and obviously helping with the funding and the investment over a long period of time, you must have a sort of timeline you're hoping to get to at a certain point, because it obviously impacts on everything that you do.
Absolutely, yeah. I mean, I obviously I have a timeline that I'm working to, but what I would say about the farm out process is this is a relatively complex thing. Farm outs in the oil and gas business are absolutely routine. Typically people do exploration well farm outs. You're maybe farming out a 10 million pound well. We're doing something that's 2 orders of magnitude more capital that we're talking about. So you can't hurry it. And I'm really reluctant to set a deadline because I know that whatever deadline I say, whatever it is, it'll be wrong.
Yeah.
So I rather say it's as long as a piece of string, and you can rest assured we're absolutely focused on doing that as quickly as we can. But I'm just not predicting.
I suppose that leads me on to the next question. That's why you would consider the company is undervalued, looking at the share price in terms of what's coming down the road.
Oh, absolutely. I mean, we have reserves. I mean, investors should really appreciate that reserves are significantly more valuable than contingent resources, which are significantly more valuable than prospective resources. And the market is currently looking at our volumes and saying there's somewhere between contingent and prospective resources. So a fair value for our shares is, in my view, quite a lot more than it is today. I won't say what number I think it should be. It's up to the market to decide.
Yeah.
It's not for me to decide.